Welcome to another deep dive. Today we're plunging into, well, really a foundational text in modern economics, Milton Friedman's seminal 1968 paper, The Role of Monetary Policy.
Absolutely. And this piece, from the American Economic Review, it's more than just some academic paper.
Yeah.
It really did fundamentally reshape how economists and policymakers, too, think about the power and, crucially, the limits of central banks.
Hmm.
So our goal for you today, really, is to pull out the core insights from Friedman's arguments, help you understand what monetary policy can and, maybe more importantly, can't do when aiming for things like high employment, stable prices, rapid growth.
Yeah, think of this deep dive as maybe your shortcut to getting your head around a really pivotal piece of economic thinking. We'll unpack how the ideas about monetary policy have shifted over time and what Friedman saw as its true vital role. Often misunderstood, right?
Definitely often misunderstood.
Okay, so let's dig in. Friedman kicks things off by noting something kind of interesting. There's broad agreement on the big goals. Stability, growth, sure. But the amazing part is how much disagreement there's been on how to get there. Which tools to use, what can monetary policy actually do. It's been a real pendulum swing.
That's a great way to put it, a pendulum swing. He points out that the relative stability of the 1920s, it led a lot of people to think the Fed, which was pretty new then, could basically fine-tune the economy, like adjusting a thermostat.
Right.
And this was partly, he says, due to advances in monetary technology, banking innovations, financial systems getting more complex, and also the huge influence of Keynes' analysis, which was rigorous, sophisticated, very compelling at the time.
But then again, the big one, the Great Contraction.
Mm-hmm.
That's Friedman's term for the 29 to 33 downturn. He argues this just completely destroyed this naive attitude about fine-tuning.
Utterly destroyed it.
Opinion swung hard. From thinking monetary policy was a string, you can pull it to stop inflation, but you can't really push on it to stop a recession. All the way over to this view of presumed impotence, like it just didn't matter much at all.
Exactly. And the widely accepted view, especially in academic circles, became that monetary policy was, well, kind of a sideshow. Maybe useful for nudging interest rates around to achieve that Keynesian idea of euthanasia of the rentier.
Ah, yes, that phrase, basically squeezing income from bondholders by keeping rates low.
Pretty much. The real action, the thinking went, was fiscal policy, government spending, tax cuts. That was how you managed the economy.
But here's the twist Friedman introduces. He looks at the Great Contraction and says, hang on, this isn't proof monetary policy is weak. It's tragic testimony to its power.
Mm-hmm.
He famously said, the horse would have drunk if the Fed had provided water. He points directly to a sharp reduction in the monetary base. The actual money supply, currency plus reserves, shrinking dramatically thanks to Fed actions. Or inactions, maybe.
Right. He saw that as a primary cause of the collapse, not just a symptom. And this perspective, this reevaluation, eventually did lead to a revival of belief in the potency of monetary policy.
Okay.
But, and this is important, often the focus shifted to how it affects aggregate demand total spending, rather than Friedman's emphasis on controlling the quantity of money itself. And understanding these historical swings, it really helps you see the roots of policy debates we're still having today.
Absolutely. So, okay, if we accept money does matter, let's get concrete. What does Friedman say monetary policy definitively cannot do? He singles out two big things.
Yeah, two really crucial limitations. First, he says monetary policy cannot peg interest rates for more than very limited periods.
Okay, why not?
Well, think it through. If the central bank pumps more money into the system, initially, yeah, market interest rates might fall, liquidity effect, right? But that's just the start. As that extra money circulates, people start spending more, prices eventually rise, and crucially, people start expecting more inflation.
Inflation expectations.
Exactly. And those expectations get built into nominal interest rates, the ones we actually see quoted. So that initial drop gets offset, and eventually nominal rates actually end up higher to compensate for the expected inflation. The short-term effect is completely different from the long-term one.
That is such a critical distinction for you to keep in mind. Short-term effects versus the long haul. Trying to fix rates long-term. It's like fighting gravity.
You could put it that way. And the second big cannot, monetary policy cannot peg the rate of unemployment for more than very limited periods.
This brings in that famous concept.
The natural rate of unemployment. Yes, this isn't zero unemployment. That's not realistic. It's the rate that's consistent with the economy's underlying structure. Things like how easily workers can move, skills mismatch, regulations, technology, the real forces, as he puts it. It's the rate you'd have even with stable prices.
So it's determined by real factors, not monetary ones.
Precisely. And if the central bank tries to force unemployment below this natural rate by, say, printing more money, it might work for a short while, but only because people are surprised by the resulting inflation. Once they catch on, they adjust their wage demands, and unemployment snaps back to the natural rate, only now you've got higher inflation. Keep trying, and you don't get lower unemployment, you just get accelerating inflation.
So attempts to hit fixed targets for rates or unemployment are doomed. They just create temporary trade-offs and maybe bigger problems down the line.
That's Friedman's core message on the limitations. Trying to force those outcomes through monetary means ultimately backfires. It creates instability, not stability.
Okay, so if it can't do those things long-term, you have to ask, what positive role is there? What can monetary policy effectively do, according to Friedman?
Right, it's not all negative. He identifies some absolutely crucial positive contributions. First, and maybe the most vital, it can prevent money itself from being a major source of economic disturbance.
So avoid being the problem in the first place, like the Great Contraction example.
Exactly. He saw that not as some inherent failure of capitalism, but as a massive, avoidable mistake by the monetary authority. Job one is do no harm with the money supply.
Got it. What else?
Secondly, it can provide a stable background for the economy. This isn't about active fine-tuning day-to-day. It's about maintaining broad price stability, keeping inflation low and predictable, and avoiding those wide swings in the money supply. A stable monetary environment lets the real economy function better. Businesses can plan, consumers can save, uncertainty is reduced. That naturally supports high employment and growth.
But provide a reliable stage for the economic actors.
A stable stage, yes. And thirdly, he concedes it can potentially contribute to offsetting major disturbances that come from outside the monetary system. Think like a massive oil shock or maybe a huge unexpected fiscal policy shift. Monetary policy could, in theory, lean against the wind.
But he adds a caveat there, right?
A big one. He's quite cautious about this, saying it's often incredibly difficult to do well. Why? Because if information lags, you don't know immediately what's happening, and timing issues, the effects of your actions take time, and you might end up making things worse, which leads into how he thinks policy should be run.
Okay, so let's get practical. Given these powers, these limits, these difficulties,
Yeah.
how should monetary policy be conducted? What's the prescription for the Fed or any central bank?
His core argument, really the central thrust, is that the monetary authority needs to focus on what it can control reliably, and that is the quantity of money. Its main job should be to maintain the value of money by managing its supply.
Not by targeting things like exchange rates or the price level directly or interest rates.
Exactly. Those are outcomes, influenced by many factors. The tool the central bank truly wields is control over the monetary base, and thus, eventually, the broader money supply. Focus on the tool.
And how should they use that tool?
He strongly advocates for a steady course, a predictable, consistent, moderate growth rate in the quantity of money. Think of it like setting the autopilot. He argues this kind of systematic, rule-based approach is far better than relying on the discretion of policymakers to react to every economic wobble.
Why? Because they're likely to get it wrong.
Partly, yes, but mainly because of that long and variable lag we touched on. The delay between a policy action and its main economic effect is significant, and it's not even consistent.
Right, the steering the giant ship in the fog analogy. You turn the wheel. Oh, wait,
Yeah.
wait, that took too much. Too little. And the fog thickness, the currents, they keep changing the delay.
That's a perfect analogy. Discretionary policy, trying to actively steer all the time, almost inevitably leads to overreaction. You push too hard, then pull back too hard. You amplify the swings instead of dampening them.
And he had examples of this, didn't he?
Oh, definitely. He cites specific instances, Fed actions in 1920-21, again in 1937-38, 1953-54, 1959-60, where he argues the authorities failed to account for these lags. They reacted to yesterday's news, and their actions hit the economy when conditions had already changed, often making booms bigger or busts deeper. That's his powerful case for a steady, predictable rule over constant tinkering.
So there we have it, a pretty deep dive into Milton Friedman's really influential thinking on monetary policy. We've looked at the historical back and forth, what he argued it cannot do long-term, like fixing interest rates or unemployment levels.
Right, those natural limits.
And what it can do, which is primarily about providing stability, avoiding major monetary mistakes, and basically setting that stable stage by controlling the money supply with a steady hand.
Yeah, and understanding these arguments is just so vital, because it helps you critically assess what you hear about economics today, about what central banks are doing. His focus on the quantity of money, the idea of natural rates, it's a really powerful lens for looking at policy and its actual effects. It endures.
Okay, so for your final provocative thought to chew on, if Friedman's right, and a stable, predictable growth in the money supply is key, what would committing to a kind of stable monetary growth rule actually look like in today's world? The super complex, globalized, interconnected economy we have now. And maybe more personally, how might that kind of policy approach impact your financial future? Something to think about.